Ever get that feeling, when financial news just kind of washes over you and you're wondering, is this company I keep hearing about actually doing well?
Or is it all just, well, hype? It's
Mm.
a common feeling.
Yeah, exactly. But what if you could figure that out yourself? Like, really get a handle on a company's health without needing a finance degree?
Well, you absolutely can. And that's really our mission for this deep dive today.
Okay.
We want to basically hand you the tools, the ability to become your own sort of financial investigator.
I like that. Investigator.
Yeah. We're going to explore how you can use, you know, readily available stuff, online free resources, to understand the real financial story of a public company.
So, taking the mystery out of it.
Exactly.
Yeah.
Making you comfortable finding that key info that actually matters.
And the best part, which you touched on, is you don't need fancy software or expensive subscriptions, right?
Not at all. Our source material really focuses on using these free, everyday tools.
Mm.
We'll actually walk through using a site most people know, Yahoo Finance.
Ah, okay. Yeah, familiar name.
Right. It's all about getting practical insights, no special access needed.
Our source used this analogy I liked putting on your detective glasses.
Yeah, I like that too. We're looking for clues, basically. Clues in the numbers that tell us what's really going on financially.
Okay, so detective glasses on. And the core questions we're trying to answer are pretty fundamental, aren't they?
They are. Things like, is this company's revenue actually growing?
Right. Are they selling more stuff over time?
Mm-hmm. And are they profitable?
Mm-hmm.
Like, after all the bills are paid, is there money left over?
Okay, profit. Makes sense. And the third.
And debt. Do they have a manageable amount of debt, or are they kind of drowning in it?
Got it. Revenue, profit, debt. The big three, basically. So, ready to dive in and use Yahoo Finance as our magnifying glass.
Absolutely. Let's do it. So, Yahoo Finance, as we said, it's a great starting point.
Mm-hmm.
Really popular, pretty beginner-friendly, too.
Okay, so first step. Let's pick a company people know. Apple. Everyone knows Apple.
Perfect example. So you go to the Yahoo Finance website, find the search bar usually right at the top.
And just type in Apple.
You can, or even better, use their ticker symbol. It's like a stock market nickname. For Apple, it's AAPL.
AAPL. Got it.
As you type, you'll see suggestions pop up. Just click the main one, AAPL, Apple Inc.
Okay, clicked it. Now I'm seeing a page with the stock price, charts, lots of stuff.
Yeah, that's the summary page. Quick overview. But for our detective work, we need to look at those tabs. Usually near the top, you'll see summary, chart, maybe conversations.
Yeah, I see financials and statistics too.
Bingo. Those are our main targets. Financials and statistics, that's where the core data lives.
All right, let's crack open the financials tab first. What are we looking for in here? Looks like income statement, balance sheet.
Exactly. The big three financial statements. Don't let the names intimidate you, though.
Okay, deep breaths. Income statement first.
Yeah, think of the income statement like a report card for a specific period, maybe a year or a quarter. It shows all the money coming in that's revenue.
Sales, basically.
Right. And then it subtracts all the costs and expenses to run the business. What's left at the bottom? That's your net income or profit. Clue number one.
Okay, revenue in, costs out, profit left over. Got it.
And Yahoo Finance usually shows you the annual numbers by default, maybe the last 3 or 4 years. You want to look for a line called total revenue,
Found it?
and then look for net income. That's the bottom line profit figure. Sometimes you can switch to quarterly data, too, for a more recent picture.
Okay. Our source had some Apple numbers as an example, right? For like 2020.
Yeah, exactly. For fiscal 2020, revenue was around $274 billion. Net income was about $57 billion.
Wow. Okay, big numbers. What about 2021?
Big jump in 2021. Revenue hit roughly $365 billion, and net income was about $94.7 billion.
A huge increase. And 2022.
Continued growth.
Right.
Revenue around $387 billion. Net income nearly $100 billion, like $99.8 billion.
So you can really see that trend. Strong revenue growth, especially in 21, and profits climbing right along with it.
Absolutely. That pattern. Increasing revenue, growing net income, that's generally a really positive sign.
Yeah.
Shows a healthy, expanding business.
Makes sense. So that's the income statement. What about that other key tab, statistics?
Right, the statistics tab. Think of this as like a cheat sheet. Yahoo Finance calculates some useful ratios for you, gives you a quicker snapshot.
Okay, shortcuts are good. What should I look for here? Seeing sections like valuation, profitability.
Focus on profitability and maybe the balance sheet summary section there. Under profitability, a really key one is profit margin.
Profit margin, what does that tell us?
It's the percentage of revenue that actually becomes profit. So for Apple, our source mentioned it's often around 25%.
So for every dollar of sales, they keep 25 cents as profit.
Basically, yeah, which
Cool.
is quite strong, especially for their industry. Suggests they have good pricing power, manage costs well.
But you need context, right? 25% might be amazing for one industry, maybe just okay for another.
Exactly. Always good to compare with competitors if you can. Another one you might see is return on equity, or ROE.
ROE, heard of that one.
High ROE generally means the company is good at using shareholders' money to make more money. Apple's is often really high, like over 100%, which is typically excellent.
Okay, high ROE is good. Then you mentioned the balance sheet section on this tab.
Yeah, scroll down a bit. You'll usually see figures for total debt and total cash.
Ah, okay, found it. For Apple, example numbers were like $120 billion in debt, maybe $48 billion in cash.
Something like that, yeah. And that $120 billion debt figure, it might make you pause, right? Sounds enormous.
Yeah, it does raise an eyebrow. That's a lot of borrowing.
It is. But, and this is crucial, you can't just look at the debt number alone. You have to weigh it against their cash and, importantly, their profits.
Ah, okay, so because Apple makes so much money, they can handle that debt load.
Generally, yes. It's
Mhm.
considered manageable for them. You might also see a debt-equity ratio here. For Apple, it can look high, maybe 200% or more.
Whoa, 200% debt to equity. Isn't that usually bad?
For many companies, yes, over 200% could be a red flag. But with Apple, it's partly because they do a lot of stock buybacks.
Buying back their own shares. How does that affect this ratio?
Well, buybacks reduce the equity part of the equation on the balance sheet. So even if debt stays the same, the ratio goes up.
Yeah.
Well, it's a bit more nuanced for companies like Apple that return a lot of capital to shareholders.
So the context is key. A high ratio isn't automatically bad if the company is a cash-generating machine like Apple.
Precisely. The main question is, can they comfortably afford their debt payments with the money they're making? For Apple, the answer is generally yes.
Are there any general rules of thumb, though, like benchmarks to see if debt is getting risky, even for a profitable company?
That's a smart question. Comparing their debt ratios to others in the same industry is really helpful. Context again.
Right. Compare Apple to other tech, hardware, software giants.
Exactly. And also look at the trend. Is their debt going up steadily year after year? Or is it stable or even decreasing? A constantly rising debt pile could be concerning.
Okay, look at the trend. Makes sense. Can we see more detail on the debt somewhere?
Get back to the Financials tab, but this time click on the balance sheet.
Gotcha. Financials tab, balance sheet.
The balance sheet is like a snapshot. What the company owns, assets, versus what it owes, liabilities, at one specific point in time. Look for a line called long-term debt.
Found it.
Our source noted that for Apple, this has actually been ticking down a bit recently, like maybe $98 billion in 2022, down from $94 billion the year before. Seeing debt go down is usually reassuring.
Okay, so the long-term portion was actually decreasing slightly. Good sign.
Yep. And you'll also see total stockholder equity on the balance sheet. That's the equity part of the debt equity ratio we were just talking about.
Ah, okay. Connects back. So we've looked at profit, debt. What about growth again? How do we easily see that growth picture?
Simplest way is back on the income statement in that Financials tab. Just look at the total revenue line across the years shown.
Right, we saw the Apple numbers, $274 billion in 2020, then $365 billion in 2021, then $387 billion in 2022.
Exactly. And you can quickly estimate the growth rate. That jump from 274 to 365, that's huge, like roughly 33% growth year over year.
Wow, 33% in 1 year is massive for a company that size.
It really is. Then the next year, 355 to 387, that's more like 6% growth. Still growing, but slower.
Okay, so you can see the rate of growth, too, not just that it is growing.
Precisely. Now contrast that. Imagine looking up a company and seeing revenue that's flat, or even worse, going down year after year.
Yeah, that would tell a very different story, wouldn't it? Like the business is shrinking or struggling.
Definitely. What kind of patterns might you see? Steady growth could be a mature company. Accelerating growth might be a disruptor. Cyclical growth follows the economy. And declining, well, that's usually a warning sign.
Got it. So pulling it together for Apple based on our quick look.
Okay, quick assessment. Revenue's growing? Check. Profitability is strong, high margin? Check. Debt is significant? Yes, but looks manageable given their cash and massive earnings? Check.
So it basically confirms what most people think, right? Apple's a financially solid company.
Fundamentally, yes, based on this initial data dive. Now, to make this feel real, the source suggested trying this with a company facing challenges, like BlackBerry, ticker BB.
Oh, BlackBerry. Okay, that's a good contrast. So if I look them up,
You'd likely see a very different picture on that financials tab, maybe revenue trending downwards over many years.
and maybe negative net income, losing money?
Quite possibly, yeah. Negative net income, maybe rising debt without the profits to back it up. It's a really useful exercise to see that contrast.
It really highlights how quickly you can get a basic feel. Our source said something like good versus bad in seconds.
Yeah, maybe not seconds initially, but with a little practice, you can answer those big three questions. Growth, profit,
Yeah.
manageable debt pretty quickly for most companies.
And if you get 3 yeses,
It's usually a decent first sign that the company might be worth looking into more deeply.
now Yahoo Finance is great, but are there other simple tools?
Yeah, the source mentioned a couple.
Yeah.
Google Finance is often even simpler, maybe less detail, but good for a super quick check.
Right.
And another one is FinViz, Finviz, also free. Gives you a lot of fundamental data at a glance. But Yahoo Finance often hits that sweet spot user-friendly, but still pretty comprehensive.
Good to know there are options. One thing to watch out for, though, those numbers can be huge. Billions. Millions.
Oh, absolutely crucial point. Always check the units. Usually at the top of the financial statements on Yahoo Finance, it'll say all numbers in thousands or in millions.
Right, so a 10,000 might actually mean 10 million or even 10 billion, depending on the units. Easy mistake to make.
Very easy. Also, negative numbers are often shown in parentheses like 100 instead of a negative 100.
Good tip. And if you're ever really unsure about the exact numbers,
The source suggests checking the Analysis tab on Yahoo. Sometimes that has clearer figures, or using a site like Macro Trends, which often lays out historical data very clearly with units specified.
okay, good safety checks. So let's quickly recap our Apple analysis again, just in plain English.
Sounds good. So for Apple, sales, growing nicely,
Check. Profitability.
very strong. That profit margin around 25% is impressive.
Check. And debt.
It's substantial, yes, but definitely seems manageable because they generate so much cash and profit. It's not an immediate worry.
Okay, so the initial verdict, fundamentally pretty solid.
Looks that way based on these core numbers.
But it's important to say not every company is going to be a clear yes on all 3, is it?
Definitely not. You'll find young companies growing like crazy but losing money because they're investing so much. That's a different story.
Or maybe stable, slow growth companies with low debt, like some utilities.
Exactly. Or sometimes industries just naturally carry more debt, like those utilities you mentioned, because building power plants costs a fortune.
So as a beginner, maybe focusing on companies that do show clear growth and profit is a good starting point.
Probably a sensible approach, yeah. Get comfortable with the clearer cases first.
Our source used Amazon is another interesting example, right? A bit more complex.
Yeah, Amazon's a great case study. Historically, you saw absolutely massive revenue growth, just incredible expansion.
But their profit margins were often pretty thin, weren't they?
Much thinner than Apple's, yeah. Because they were famous for reinvesting almost everything back into the business. Warehouses, logistics, new ventures, AWS.
Ah, AWS, Amazon Web Services, their cloud business.
Right. And the huge cash flow coming from AWS became a really critical factor, even when overall company profit margins looked slim.
So if you just looked at the big 3 for Amazon years ago, growth, yes, profit, kind of low margin, debt, they had some. It might have seemed mixed.
It might have, yeah. It required a bit more digging to understand the reinvestment strategy and the power of AWS cash flow. It shows the basic check as a starting point, but sometimes you need more context.
Okay, that makes sense. It's a good first filter, but not the whole story for every single company.
Exactly. Now, looking ahead, once you're comfortable checking out individual companies like this,
What's the next step?
well, the source mentions learning how to scan the whole market for companies that meet your specific criteria, using something called stock screeners.
Ah, okay. So instead of looking up one company, you say, show me all companies with revenue growth over X% and profit margin over Y%.
Precisely. And the key thing is the metrics you use in those screeners.
Yeah.
They're the same ones we've just been talking about. Revenue growth, profit margin, debt levels. This is the foundation.
Got it. So understanding this stuff first is essential before using screeners effectively.
Absolutely.
So the call to action for everyone listening is what? Give it a try.
Definitely. Take this knowledge, head over to Yahoo Finance or Google Finance,